Let's talk about that. This is important. So take a look at this chart. Take a look at this chart, and you will see that it comes from Bloomberg. And what it shows is that the percentage of companies in the Russell 2000, that is America's small cap stock index, lots of opportunities there. They have negative earnings over the trailing 12 months. What percentage of small company stocks are basically losing money? Okay. So when it shows a percentage, right? So as we head into 2025, the number is about 40%. 40% of the companies have no earnings. And also, as that's 40%, so nearly half of America's small cap companies are losing money. And that is a reason why you have to be very careful when it comes to investing in small company stocks. Because, they're basically losing money. But it does not mean it is a bad thing. And I will explain. So let's take a look at it in very much detail. So they're losing money. So let's take a look at the more in detail. So the time series goes all the way back to 1995. And it basically runs through it goes from March 1995 all the way to the left to March 2025 all the way to the right. Okay, so and the law moves roughly 10% at the low end and 45% at the high end. So the percentage of company in the Russell 2000 with negative earnings. So if you look at all the way to the left, you're seeing March 1995. And at that time, about 15% of the companies, and then you go all the way to today. So what does this mean? Well, the charts also show in shaded area the major recession periods. The dot-com recession, 2000, that's the first gray one. The global financial crisis, that's the second bar, was a bad one. And of course, the little tinier one, but still significant, the pandemic recession. So what's striking is that every time we hit one of those economic shocks, the percentage of unprofitable company surges dramatically. Why is that? What is going on, right? That is very important for you to understand, because at the end of the day, what we're saying is that these companies tend to be losing money. And but here's a twist. The level that we have today, around 40%, is not associated with a recession. This is happening during what's supposed to be a strong economy. Look at it, people. Look at it. Look at the first bar, the first brown, the first shaded area. That little green line is shooting up from 20 to about 30% not making any money. Then it gets better. Then it shoots up again in 2009, as you could see, the curve and the green line. And again, it curves up during the COVID. But since then, it keeps, 40%. It drops back. After each bad area, it drops back, but it's not dropping down again. So that's a red flag. That is a red flag. Again, my theory has been of all the videos that I'm showing you is that we are doing okay. We're at the beginning of something that looks like we're going to be making money in the stock market for a while, but you have got to watch the downside. Any sign of downside, any sign of a black swan. That is what we need to do. Okay? And that's what the channel is about, quite frankly. Don't forget to subscribe. So let's take a look at the first one, the first bar, the first shaded area, the dot-com bust, 2001 to 2003. Small caps saw unprofitability surge to around 30 to 33% as growth companies collapsed. But that was also a moment of massive overvaluation, excessive optimism, and easy money flowing into a company with no viable business model. That was a dot-com bubble. And that doesn't mean that the AI is the same way, that it's going to burst. Because frankly, do not associate dot-com with AI. It's a very different. AI, they're actually making stuff that people actually want. The global financial crisis. Let's take a look at it in 2008, 2009. This is the biggest spike on the chart before 2020. More than 40% of small caps lost money as credit froze, demand collapsed, and debt burdens crushed weaker business. Do you remember those days? Today's level is approaching crisis high. Then, of course, we've got the pandemic shock of 2020. Remember COVID? In early 2020, we again see a massive surge pushing forward to the mid-40s. But that spike was temporarily driven by forced shutdown and unprecedented disruptions. But yet, after the pandemic, the line doesn't fall back to the early 2000 level. It's kind of staying at around 40%. That is an issue. That is a concerning part. You know, we used to see unprofitable small companies spike only during recessions. Now we're seeing a persistent elevated level even as the economy grows. This implies that structural factors, not cyclical downturns, are keeping nearly half of the small caps in the red. So why are so many companies losing money? Right? Why are they losing money? What is going on? What's happening? First, rising interest rates and debt pressure. The Russell 2000 is heavily indebted compared to the S&P 500. Why? Well, because small caps rely on credit markets far more than mega caps do. When you're a small company, you need financial, you need debt. Who's going to lend you? How are you going to start with no money? Right? You got to go to the bank, you got to go to the market. You need debt, right? To come in, to feed you, to make you a better company, to grow basically. And once you grow, you can make enough money, you don't need. Like in real life. So when the Federal Reserve takes interest rates from 0 to above 5%, the debt servicing burden explodes. And that's why in my Patreon channel, what I do is I make recommendations as to which actual companies are making money. I know how do you decide, how do you look? Again, this is in my Patreon channel. But the point is, rising interest rates and debt pressure. When the Federal Reserve takes above 5%, that's expensive. For many small companies, their interest costs now exceed their operating profits. And that is the reason why you have to be very careful as to what you're looking for when you look for a company. You need to make sure that, the charts, it's not at 40%. You cannot lose that much money. That alone can push into negative earnings territory. Now, the way you could fix that, quite frankly, is you can take a look at different type of companies. You could take a look at that, and what you could say is, let me look at EBITDA to interest expense. Let me look at EBIT to interest expense, operating profit to interest expense, debt to EBITDA, to make sure whatever companies you pick, at least it's able to pay its debt. So that's the first thing that happened, rising interest rates and debt pressure. Number two, margin compression from inflation, input costs. Remember inflation business? Tariffs, input costs, wages, material, logistics jumped over the past 3 years. Large companies have pricing powers, but small companies, they don't. They face a squeeze, a cost squeeze. You can't raise prices enough. Costs are rising faster than revenue and profit evaporates. This also explains why the Russell 2000 has lagged the S&P badly since 2021. And that's why, no one wants to invest in Russell 2000 small companies because, frankly, they're not making any money. And that's why they all went after the Mac 7. 3. Zombie companies created by the zero-rate era. During 2008 and 2021, cheap money allowed thousands of weak businesses to survive. In 2008, when the whole thing was collapsing, they say, you know what? Here's free money for you. Everybody took it. Venture-backed firms burning cash. Roll-ups dependent on debt. Companies whose cost of capital was artificially suppressed. Once the cost of money normalized, profitability became an existential challenge. We may be witnesses the slow unwinding of a decade of free liquidity, meaning forever. Rates were at 0%. It didn't cost anything to borrow. They said, let's do it. But this is different. So in terms of sector composition, the Russell 2000 are heavy exposure to biotech, early stage tech, energy exploration, and regional financials. These sectors naturally show more volatility and more negative earnings. But even adjusting for that, the current 40% number is extremely elevated by historical standards. So what does this matter, right? Why does this matter for markets today? Well, market breadth, credit markets, small business employment, recession risk, and equity volatility. So in terms of market breadth, it's much weaker than headline indices suggest. The S&P 500, driven by the Magnificent Seven, makes the economy look strong. But underneath the surface, 40% of small companies are losing money. 2, a huge share of small companies can't refinance the debt. It's too much. Rates are still high. Don't forget, when you hear 3%, the Treasury is at 4% right now, right? They don't borrow at 4%. These companies borrow at Treasury plus 200 to 300 basis points, like 4, 5, 6, 7%. Equity issuance has dried up. Valuations remain elevated despite fundamentals. This creates fragility in the market's foundation. That is why, this channel basically looks for all these things for you. It's saying, be careful. Yeah, market is up. We're making money. Magnificent's doing great. Unemployment is low. But this certain things growing underneath, certain signals are telling you, the coast might not be that clear, at least might not be that clear for a long time. I'm seeing you've got maybe a couple of months, maybe a year to catch up, if you keep, piling up valuations. And then every day that goes by, you are more and more likely to an event that no one is expecting, and you cannot afford any mistake. At these levels of valuation, you cannot avoid any mistake. So why this matters for credit market? Well, the credit cycle is tightening. What does that mean? Small caps will feel the credit crunch too. Banks are tightening standards. Private credit is more expensive. All the stories about private credit. Bond yields remain high. Companies with negative earnings struggle to roll their debt. That is how defaults begin to rise. And small cap defaults are a leading indicator, not a lagging one, of economic downturns. They are the canary in the coal mine. They are the first one to get hit. The Russell 2000, which is all about small companies, is telling us something about recession risk. Look at the historical pattern. Whenever unprofitable small caps rise above 35 to 50, right? Look at the chart. Starts to rise up before the recession hits. So this could mean one or two things. A recession is closer than people think, and the post-pandemic economy is structurally weaker than the headline GDP suggests. Another reason, equity volatility could rise dramatically. Unprofitable companies are more sensitive to rate changes, more vulnerable to earning shocks, more likely to experience liquidity stress, and more prone to large price swings during corrections. This environment breeds higher volatility in the Russell 2000. If the Fed signals higher for longer, or if unemployment ticks up, these companies could sell off sharply. So, gotta be careful that if you're going to go into small company stocks, that you know what you're getting. The broader message of the chart is as follows. It's not just about small caps. Yes, it shows you the percent of companies, small cap companies that have negative earnings, but it's also showing a bigger story. The U.S. economy has bifurcated. On one side, you got the mega caps, the cash-rich giants, the tech monopolies, the firms benefiting from AI, scale, and global. And on the other side, you have the extremely profitable. These are profitable, but then on the other side, you have the small leverage company, the startup, the regional players, the businesses with thin margins, firm exposed to financing costs. These companies are struggling to survive. And what we're seeing is a widening divide between the two. And the Russell 2000 continues to telegraph that the real economy is not as healthy as the headline numbers imply. But are you hearing this? Are they telling you this? Well, they don't want to panic you. Make sure that you keep investing. So looking ahead to 225, end of 25 and to 26, the Fed cut. So scenario one, the Fed is going to cut rates, which they have. If the Fed cut rates aggressively, interest rate burden ease, refinancing becomes survivable, small caps could rally. So that's what we've been saying, and that's what's happening, right? But the Fed will only cut aggressively if growth collapses or unemployment rises. Not if you're doing great, because then you're going to create inflation. Rates stay higher for longer. If the Fed hold the rates right now, which they probably do, although they're gonna lower rates this week. Defaults are gonna rise. Unprofitable percentage could climb towards pandemic levels, and small caps may enter a full quarter earnings recession. Scenario 3, what you could have a soft landing. If growth stays stable and inflations keep falling slowly, you might see companies gradually regain profitability. But given debt rollover schedule for 2025, 2027, the soft landing might be optimistic, meaning there's a lot of debt rolling over. Meaning that they took the debt when it was at zero. Now you're going to start seeing them clocking at not 3%, at 4, 5, 6, probably 5, 6, 7%. I mean, usually the debt of small companies and middle market companies in corporate banking, they give you, 3, 4, 5 years, not 20 years. So you're locked in for 3, 4 years, but what happens when it reschedules? So the real message, 40% of small cap companies are losing money. The level historically correlates with recession. The current reading is structurally high, not cyclical. Debt burdens, inflation, and tightening credit conditions are driving the weakness. We need to see lower rates. If the U.S. economy is going to achieve a true soft landing, the number needs to fall significantly. And we're going to keep tracking that for you. We're going to make sure we understand what you are seeing. Next. This is a doozy. Okay. Let me show you this one. So basically, you're probably kind of self-explanatory when you look at this thing, but you're seeing this famous pie chart. Okay, so what are we looking at? Give me a second. Okay. What are we looking at? The chart, this chart shows just how extreme the concentration in the US stock market has become. Look at this very carefully. It shows that the market cap of just 7 companies, 7 companies, the so-called Magnificent Seven, is now equal to the combined market cap of the bottom 449 companies in the S&P 500. Both sides, about $22 trillion. So what does that mean? Well, take a look at the left side. We see a dense cluster of hundreds of tickers, hundreds of companies representing the bottom 449 components of the S&P 500. Don't tell me that the S&P 500 is diversified. Together, all of them combined produce a total market of about 22 trillion. Now look at the right side. Right? Simple pie chart. You have 7 companies: NVIDIA, Apple, Microsoft, Google, Amazon, Meta, and Tesla. Those 7 equal the same combined valuation as the other 449 companies. One pie slice versus a swarm of dots. That is what concentration risk looks like. That is what a market dominated by mega caps looks like. And that is what investors' dependence on a very narrow leadership group looks like. Now, of course, keep in mind, we're talking Amazon, Meta, Tesla, Google. I mean, these are not Mickey Mouse company operations. Right? They're doing things, they're making things. That's why I don't often compare the AI boom, quote unquote, with the dot-com bubble burst. Right? It's different animals. We're paying a lot for them both, but different animals. So let's dive into why this happened, and because it doesn't happen by accident. 1, winner-take-all companies. Technology companies benefit from network effects, zero marginal cost scaling, and extremely high operating leverage. Huge global TAMs. Once a tech company wins, it keeps winning. This dynamic concentrate value at the very top. 2, why is this happening? AI as a generational catalyst. The biggest contributor in 2023 and 2025 has been AI, especially NVIDIA. Right? NVIDIA alone added trillions in market cap in under 2 years. 5 trillion we're talking about just for NVIDIA alone. In dominance, its dominance in GPU is the single strongest monopoly-like position we have seen since early Microsoft Windows. 3, why is this happening? Why do we have this concentration? Well, ultra low cost of capital, growth stock domination for over a decade. Interest rates were near zero. Right? Interest rates were near zero. Growth stocks thrive on low rate environment because future earnings become more valuable. So capital flowed overwhelmingly into tech. Able to pay, and rates are low. Number 4, why is this happening? Passive investing reinforces the trend. What? A massive share of all new investment dollars now go into index funds. Whenever you have a 401k, right, and every month you put your money in and they match you and it goes into your 401k, where do you think they put the money? They put the money usually because they don't want you to lose any into index funds. And it makes sense because 80% of portfolio managers lose up against the index. They're not able to beat the stock market index. index funds allocate based on market cap. So the bigger a company becomes, the more dollar it automatically receives. This is self-reinforcing. NVIDIA goes up, the index goes up, buys more NVIDIA, NVIDIA rises again, concentrations decreases every year. And that's the reason why, I mean, the S&P as a fund, right? It really doesn't care what happens in it. Now, you people could just buy all the NVIDIA in the world and don't buy anything else, and you have one stock. So instead of a chart like that, you've got like one stock and then 499 on the other side. That's going to keep on going. Nobody's going to care about that because S&P is an index. It's an unmanaged. But if you're a portfolio manager, you have a natural bias. You cannot go to your credit committee or to your investment committee and say, look, we're doing so great. Let's just buy one stock. Let's put $2 trillion, all of the investors' money into one stock. You're going to say, you're crazy. We have to diversify. So by definition, you cannot pick just the winners. You got to diversify, right? Because you're not going to walk around with just one stock. If you're wrong, you lose everything, right? Nobody's going to do that. And that's the reason why a guy like Warren Buffett says, I don't believe in diversification. It is called diversification. So, is this normal, this concentration? Has anything like this happened before? Yes, but never to this extreme. In the late 60s, the US had the Nifty 50. In the 90s, we had Cisco, Intel, Microsoft, the dot-com leaders. But even at their peak, the largest stocks never equaled the bottom 90% of the index. Today, 7 companies equal 449. We had 50 at one point, not 7. This is the highest concentration in S&P 500 in recorded history. When the top is this heavy, the index is no longer a diversified portfolio. It becomes a bet on a very narrow basket of tech giants. That is the concern. What does this mean for investors? What does it mean for you? I'm talking here, I'm telling you stuff, showing you things. What does it mean for you? Well, the S&P is no longer the market. It is a mega cap tech fund with 493 small appendages. If Apple sneezes, the S&P catches a cold. Keep that in mind. Volatility at the top equals volatility everywhere. If the S&P, if the Magnificent Seven correct by 20%, at the bottom 449 rises by 5%, the index still falls. So all these companies could be doing great. But if the Magnificent Seven loses out, everybody loses out. So that's how top-heavy things are. Diversification is weaker than investors think. People say, I'm safe, I'm the S&P 500. But in reality, you're basically in 7 stocks. Market narratives becomes binary. Right now, the market narrative is AI boom continues, the S&P surges. AI momentum slows, S&P reverses sharply. We no longer have a balanced economy-based index. We have a technology and AI-driven index. You may or may not care, but if your money is in indices, you better care because that is a problem. So it is basically like Bitcoin. If it tanks, all the others do. Exactly. Bitcoin, right? Yeah, that's true. And what we have, right? We have this situation where let me see if I could show you the Bitcoin, but it's a problem. The problem is there for as far as Bitcoin is concerned. So yeah, that's what you're looking at. Bitcoin is at around $90,000. If they go up, everybody goes up. If they go down, everyone goes down. So what are the macro implications of this? Well, this level of concentration doesn't just affect portfolios. It affects the economy, the political policy, monopolistic oversight, and global competition. I mean, tax revenues are basically tied to a handful of firms. A large portion of capital gain taxes and corporate tax revenue come from these giants. 2, US GDP increasingly shadows big tech companies' earnings. When Apple, Microsoft, and Nvidia slow, US productivity indicators slow too. 3, regulatory pressure rises. When 7 companies are disproportionate economic power, Congress and global regulators pay attention. Antitrust scrutiny, AI governance debates, export controls, data privacy battles, competition policy shifts. So geopolitical leverage changes. Take dominance equal geopolitical leverage. What do you think right now is going on with NVIDIA? The U.S. administration has basically stated that they will allow NVIDIA to start selling in China. And then China said, whoa, hold on. We don't want to take all of your stuff. We don't want to be flooded with your stuff, with the NVIDIA chips. So there's a geopolitical leverage going on here. So what are the risks ahead for you? Well, let's talk about risk. Not doom, not collapse, but realistic structural risk that exists when markets become top heavy. Risk 1, you have reversion to the mean. Historically, concentration cycles always revert. You can't keep expanding exponentially, upward. The leaders change. The market broadens. But when you are concentrated at this level, reversion can be violent. 2, the risk of regulation. Government tends to break up or restrict dominant companies. You saw it, if you remember, Standard Oil, AT&T, Microsoft, Meta, Google. The next round of tech regulation will be even bigger because the stakes are higher. Risk number 3, you have the AI bubble risk. Right now, AI is transforming the world, but we must ask, are valuation pricing imperfection? If earnings disappoint even slightly, AI-linked stocks can pull the entire index down. And when 7 companies drive all returns, the index becomes fragile. If money rotates out of the Max 7 into smaller stocks, and this is kind of the impetus of my recommendations to my Patreon channels, is that, you want to get in there. Right? The overall index may stagnate or fall, or even as many individual stock rise. This creates a strange environment. The market is flat, but your portfolio is doing great or terrible depending on whether you own the Magnificent 7. And that's why I always say, you want to buy when everyone else is selling. And right now, everyone is with the colorful charts. You want to be on the left side. That's where the money is going to be made. What are the opportunities? Well, it's not all risk. There are real opportunities emerging. First, undervalued sectors in the bottom 449. Industrials, bank, energy, biotech, materials, many are historically undervalued. And I make that recommendation all the time to my Patreon members. 2, a potential broadening of the market. If interest rates fall, capital may flow back into the laggers, That's why we want to see lower rates. 3, stock pickers regain relevance. When one sector dominates, passive investing wins. But when the market broadens, active strategies outperform. Meaning that, forget these guys. Let me go after my small companies, with low P ratio, with low debt, with growth. Right? The Magnificent are dominant for a reason. Their business are extraordinary. This is in 1999. Sales, profit, cash flows are real. But in conclusion, I will say this. 7 companies equal 449 is not just a visual curiosity, it is the story of our entire market. It tells us the following 5 points. 1, than ever before. 2, investor risk is heavily tied to a handful of companies. 3, AI has created one of the biggest winners take all moments in financial history. 4, the S&P 500 no longer behaves like a diversified benchmark. And 5, the future path of markets will be shaped by the decision of just a few firms. All this because 7 equaled 449. That's a decision you need to make. You need to decide what to do. You want to be in the stock market, you better understand what's going on. You better understand that, you know what? Shouldn't I be on the left side? No. Be on the right side because everyone else is there. You do not make money when everybody else is making money, meaning that you do not make money by buying when everybody else is buying. Unless you're so lucky, right? You're so lucky that you're catching that wave. But how do you know everybody else is making money? How do you know everybody else is buying? The stock is going up, right? Unless you start buying on Monday and then they start buying on Tuesday. Well, but that's just pure luck, right? That doesn't happen. You want to buy when everybody's selling. That is the best, right? Because it goes up, right? It goes up. Once it starts going down, you could see it going down. Then you buy and buy and buy and buy and buy. That's how you make money. It's a lot easier to catch it on the way down than to catch it on the way up because you don't know you don't know how high it could go, right? But on the way down, you know that there is a floor there. If you're there in the market, the stock is going down, you buy, you know at some point there's a bottom. But if it's like this and you're buying and buying and buying and buying, what happens when it reverses? Take a look. This is telling you, look at the chart that I've been showing you. I mean, first of all, we're highly concentrated. This is the highest concentrations ever. They were never the Magnificent Seven. We would call it the Nifty 50 because there were 50 companies, not 7, not the Magnificent Seven, after the very famous John Sturge movie of the 60s that you remember. Briner and these guys. They made a few movies, but they didn't work out that good because that's the original. The point is, we never had the Magnificent Seven in the 60s. We had the Nifty 50. Okay, now, let me show you this. Let me show you this. That's an interesting chart. Take a look at this chart and learn something today. Because you know what? At the end of the day, it's all about the learning. You're here to learn. Because once you stop learning, not a good place to be. So let's take a look at the third chart. Sector P, right? Because at the end of the day, it's all about, how much are you willing to pay for something? Let's go through one of those charts that I think are extremely important that you've seen all quarter. This is the forward P re-rating map by sector, showing how valuation across the S&P 500 have shifted from October 29th to November 20th. Very colorful chart. So what has happened? It shows that which part of the market investors are fleeing and which part they're still willing to reward, and which sectors are quietly turning into a valuation traps or opportunities. Now, again, the P ratio, which is a price to earning, is basically how many dollars are you willing to spend for each dollars of earning of a company. Right now, for example, the P ratio for the Tesla is like 150. Well, the P ratio for NVIDIA is 40 to 50. What does that mean? What does it mean? And don't forget to give me some thumbs up here. What does it mean? It means that I'm willing to spend $150 of my money for every dollar that Tesla brings in. But I'm only willing to pay $40 or $50 for every dollar that NVIDIA brings in. Why? And that's the big mystery, quite frankly. And the market average is around 20, 30, but I tend to look at companies with 10 to 15 P ratios to make sure that I don't get caught off track. So this chart is extremely revealing. It shows which part of the market investors are fleeing. So what is it actually telling us? Well, each bar, so let's understand what this is about. So each bar that you're seeing, the red and then the blue, shows black dot forward PE in October 29th, the short-term peak, right? And the gray dot, which is underneath, the forward PE on November 20th. So the black dot is October 29th, and the gray dot is a month later, November. The red zone, it means that the sector has been re-rated lower by the market. The blue zone means the sector has been re-rated higher, meaning that the gray dot is above the black dot, meaning that I am now pricing the P ratio higher. I know it's a little bit complicated, but you have to bear with me here. So basically, if it's blue, that means the gray dot is above the black dot. And the gray dot is basically the forward P, how many time I'm willing to pay per earnings on November 20th. And the black dot is in October 29th. So obviously, if I'm willing to spend more money going forward, that means I'm seeing that it's, worth more. So in simple terms, the red investors are demanding cheaper valuations. They don't think that I don't want to spend that many times for each dollars of earnings. And if it's blue, investors are willing to pay up. This is the purest real-time sentiment indicator because valuation re-rating happens before earnings and before price decline accelerates. So it's another way for me to help my subscribers and my Patreon members. Now, let's begin with the most dramatic story, obviously, right? Tech, all the way to the left. So tech valuation. Tech saw the largest re-rating lower of any sector. Forward P dropped from 31 to 27. Again, in 1 month, October to November. This is a massive compression, meaning I'm not willing to spend a lot for each dollars of earning. Even if your earnings are going up, I'm willing to spend less. I'll give you $31, I'm giving you $27. This basically tells us three things. It's telling us that investors no longer want to pay peak AI premiums. We've been in a 1.5 year long regime where everything with AI exposure commanded whatever multiple it wanted. The era is now being challenged. 2, growth expectations are being re-anchored. Earnings may still grow, but investors are pricing in slower growth in cloud, CapEx digestion cycles, and margins normalization. 3, leadership fragility is emerging. For 2 years, Markets believed tech was bulletproof. Tech can still bleed multiple points when sentiment cools. This is a high valuation sector, but the direction of change is a story. Now let's look at the second one. Now, obviously, as you could see with discretionary, they don't pay $31 for each dollar of earning. They'll pay up to 26.9. But still, that also fell. This align almost perfectly with weakening consumer confidence indicators, credit card delinquencies, slowing unit volumes, and margin pressure. Investors are basically saying, we still like the sector, but not at those frosty multiples. Now, industrials, same thing. We dropped from 24.4 to 22.9. This is interesting because industrials have been viewed as a quality, safe kind of haven, benefiting from reshoring trends, global capex cycles, and infrastructure spending. But even here, investors ease up the throttle. So we're saying kind of across the board situation, right, where we are basically kind of not wanting to spend much money on these stocks anymore in terms of valuation. The market is lowering expectation on cyclical growth, not just consumer sensitivity. Industrial meaning cyclical growth, we're talking about, car companies, big ticket items that go up and down with the economy. Let's take a look at communication services. Communication saw a decline from, again, 20.9 to 20.3. This is one of the smallest re-ratings lower in the entire chart. Why? Because the sector is bifurcated. Communication services, you got mega platform like Google and Meta has become cash flow machines with improving margins, while telecom operators continue to struggle, but their weight is smaller. This sector is acting like a quasi-growth, quasi-value. Investors seem comfortable holding it without demanding its deep discount. It's very mild. And then, of course, you've got materials, utilities, financials, materials fell from 18.8 to 18.3, a subtle move, but consistent with falling commodity prices, lower PMI readings, and a market anticipating slower construction demand. Investors still like the balance sheet. They just don't want to overpay. Then you've got utilities, 18.9 to 18.2. Again, we are paying less on all these things, not as much as tech at 31, but still, utilities had a monster run in 2024, 2025 because investors thought they were the new defensive AI infrastructure play thanks to data center power demand. The data centers, but rising rates and regulatory pushback slowed the momentum. Financials, what's going on with financial? Well, the forward P went from 16 to 15.7. Small decline. Why? You're benefiting from stable deposit bases, improving credit conditions, and normalizing rate spreads, but concerns linger about commercial real estate exposure, consumer credit contraction. Investors trim valuation, but they didn't abandon the sector. And then finally, energy, kind of flat. This is actually bullish, right? Because despite volatility in crude prices and geopolitical noise and OPEC uncertainty, valuation in energy are already so compressed that the market has almost no room to re-rate them lower. Energy is quite stabilizing and may be poised for expansion if demand rises in 2026. Anyway, so the only reductions that are positives are the staples and healthcare. Consumer staples, what people want. Forward P moved from 20.9 to down to 20.7. But the sector is shown as blue because relatively to the market, staples were treated positively. This tells us that investors are rotating towards quality income, cash flow consistency, and defensive earnings, kind of in line with what we're seeing in the other charts. That's saying, maybe we might be overextended here. Maybe we should kind of take it easy. Even a tiny re-rating upward means investors choose staples. while selling down almost everything else. Healthcare, the big winner. Forward P rose from 17.5 to 18.2. This is a strongly positive signal of the entire chart. That's a little bit worrying because that means that we're not willing to pay as much as before. Healthcare is being rewarded because 1, pricing power is stable. 2, demand is non-cyclical. 3, innovation pipelines are strong. 4, GLP-1 cost pressures have eased. 5, biotech sentiment is recovering and managed care is stabilizing. This shift suggests a rotation into sectors with stable margins, long-term demand, and less exposure to rate volatility. That might be your canary in a coal mine. The macro implications. So what does this all mean? Right? You need to worry about this. Well, let me tell you. First of all, this is a late cycle valuation pattern, meaning high multiple growth is being compressed, defensing is being rewarded. That means near turning points. This usually happens when you have a turning point in Fed policy, earning inflection points, and GDP slowdown. We are heading towards something, folks. And I think some people see it. Doesn't mean that we're going to collapse. It means that you need to prepare yourself. 2, market leadership is getting narrower. Tech, discretionary, industrial, all re-rated lower. Only 2 sectors, healthcare and stable, the only winners. This implies that investors are preparing for choppy or slowing macro data. 3, volatility ahead is likely. When you see valuation compression leads, price volatility usually follows. This chart is the canary in the coal mine. The market is prioritizing cash flow over growth stories because they already paid so much. What should you take from this? Well, sectors the market is rejecting is tech, discretionary, industrials. They aren't sales, but right now investors don't want to pay top tier multiples. It's not like you're not buying. It's like you're selling. You're not buying as much, right? So the sector market is neutral to cautious, but that tells you that you shouldn't be buying anymore because everybody else is not buying, and please don't buy when these people are going to start selling. They're buying more. Sectors, the market is neutral to cautious. Communications, materials, utilities, financials, energies, stable but no leadership. So in closing, I will say this. And don't forget to subscribe to the channel. If you want to understand where money is flowing, where risk is rising, and where opportunity is quietly building, this chart tells the whole story. Right? It tells you, you may want to be on the right. Be careful about the left. I'm not saying don't be on the left. I'm saying be careful about the left of the chart. And that's why I created the channel. I created this channel called The Black Swan so that you know where the risks are coming from. I mean, this thing is talking to you. Of course, it's not as obvious as some guy showing up on, one of the other channels saying, sell, we're going to have a, it's not like that. You're looking for an easy answer. There is no easy answer. It's just watch, understand, and know this. Know this. You should know that you do not know. That is very important for you to make money in the stock market. Don't forget to subscribe, and don't forget, more importantly, to join my Patreon channel, because there I'll make actual recommendation based on all the things I talk